I'm pleased to welcome you to the Investment Strategies panel today, and I am very delighted to be the moderator of our panel. And we have today three speakers that are experts in their areas. So I would like to start presenting myself. My name is Krasimira Paunina, and I'm Chief Executive Officer at Select Asset Management. Our company is one of the first Bulgarian asset management companies in Bulgaria, and we have more than 17 years of financial services experience here. And it's a great pleasure for me to introduce our speakers today. Dr. Боряна Рачева will be with us. She's a Senior Vice President at FactSet. In this role, she leads FactSet's business line for risk, which includes research, product development, and business strategy. She's as well the co-founder of FinAnalytica. And she has over 15 years of experience in building risk and quant portfolio management software solutions. Here is Mr. Alexander Pravits. He is the head of Sea and Mediterranean and Schroders department, and he is responsible for the business and strategic development in this region. As well, we have Mr. Petr Zaic. He's the senior fund manager at Amundi Asset Management, one of the leading global asset management companies, and he's an expert on the full range of capital market instruments, and he's specialized in portfolio management. Today, we will discuss the main investment strategies this year, the investment outlook for 2021, and at the beginning, I would like to start with the news everyone maybe knows now, that at the beginning of November marked a turning point for capital markets. Positive news regarding vaccine development fueled optimism that the declining number of COVID infections will trigger a global economic recovery, and investors now have clarify with regard to the peaceful transition of leaderships in the US, and have welcomed the selection of former Fed Chair Janet Yellen as President-elect Joe Biden's Treasury Secretary candidate, which suggests tighter coordination with the Fed. These developments were positively received by stock markets. But however, the short-term outlook remains uncertain, and sentiment alone will not be enough to compensate the physical market due to the fact that we have reintroduction of lockdown measures across most advanced economies in response to the upsurge in COVID-19 cases in the past 2 months. So now I would like to start our discussion today and begin with one of the most interesting questions, I think. What happened on the capital markets? What happened with our clients with their investment strategies? Have we seen something new, something unseen till the moment? And in this regard, what happened with our strategies, with our ideas for the fund management? So if you want, we could start with Peter, for example.
Okay, good afternoon. I guess you have already afternoon in Bulgaria. Yeah, this year was quite specific, and I need to say that some way extreme, because we have seen the crisis which or economic slowdown, which was not seen at least for the last 10, 11 years since financial crisis 2008 and 9. But over the same time, we have seen rallying markets, especially in the second half of the year. So we have now one of the record divergence between earnings on the company side, so profitability on the company side, which are declining 11% in US on average, slightly more, and 30 to 40% in Europe for this year. And on the other hand, we see a positive performance of the equity markets in US and big or smaller losses in Europe. We are also seeing extreme divergence or outperformance of the growth stories, growth stocks over the value ones, which is right now, or which have been at the beginning of November, highest ever, even higher than in dot-com bubble 2001. So those are the specific of the market. The investors, due to the enormous flood of liquidity, are now looking through the valley. They are not focused what happened right now, but they are focused on what they are expecting to happen in the next 12 to 24 months. So that explains what we've seen on the market, and this is quite specific because this is some kind of action which we never seen before.
Yes, that's right. I think that we have seen, and we see now that our clients change their perception of markets, and I can testify that we have more calmer clients. Clients want to invest their money, but not at any price. And these last 2 months are so bullish. But if we would like to change something, to shift our investment strategies, maybe the moment is in the next 2 to 5 months. And it will be very interesting what will happen on the Fed and ECB meetings in the late December, for example. I would like to ask Alexander as well, what do you think about our region? What happened? We have seen that the advanced economies are so bullish now, but this is not the case here in, for example, in Bulgaria, in Poland, in Hungary, and even in Greece. What do you think?
Yeah, that's true. I mean, Dobor den to everyone listening in. It would be better to sit in front of you, but we use technology now and get adjusted to the new reality. I think something similar can also be said for financial markets and investing, because a lot of the theories that we have built our portfolios on over the past 50 to 80 years or so are really being questioned at the moment, right? Because never have we seen so much money flowing in to markets. I mean, if you look at central banks' balance sheets and you compare it to before world financial crisis levels, they have added around 20 trillion, that is with a TR at the beginning, of US dollars onto their balance sheets. You could say that we are in a financial experiment never experienced in human mankind, okay? So, and how this turns out will need to be seen, okay? So it is not quite clear the direction. At the moment, in a short-term basis, clearly risk assets and the outlook for risk asset, with risks being low in geopolitics, obviously the US election being behind us, and Biden at least being a more, shall I say, reliable partner to most of the world than what Trump has done with, where he can basically, change in decades built alliances with just one tweet. I think that's over and that's behind us. And obviously super supportive central bank policy and also fiscal stimulus that stands behind it. It's very good for growth markets. And that's what we've seen, quite frankly. And why am I saying we have to revisit, some of the financial theory that we have built since modern portfolio theory, is that yes, valuations are very high, but we have also set this 1 year ago in November 2019, right? And guess what?
Okay.
When I ask our investment specialists from the multi-asset side, they have this same problem since the financial crisis. Every year you kind of look at, oh, it's expensive, should we invest, should we invest? So if investors, and I mean, obviously the professional investors will know that, but we also, I understand, have some high net worth individuals being dialed in, always stand on the sidelines saying, oh, it could be too expensive now, let's wait until we see a new correction. Guess what? They will never get in. So my point is, make your assumptions as to where you want to be, where you want to go, what the level of income is, or return, or the amount of money you might need in 20, 30 years when you retire, and just start to invest today, have a diversified portfolio that is kind of skewed towards your risk, and then take it from there. And when volatility comes, and trust me, it is coming, and we will see a lot more of that in the coming 5 to 10 years, then use this as buying opportunities. And I think it's just a kind of a new way of approaching investments, and that's what I'm saying. So you need to rethink some of the theories that we've built over the past kind of 50 years.
In the light of your comment, I would like to invite Borjana as our risk expert to discuss the issue with the risk perception of all investors. And Borjana, what happened? Did the risk perception change in some way this year? And what the institutional investors, for example, and the retail investor as well, think about the risk indicators, maybe which are the most important indicators we should observe in the next year.
Yes, Krassimira, thanks first of all for the invitation, and good afternoon to everyone who is here with us today. Indeed, I think that 2020 was a year of really rethinking, first of all, our vision with regards to how financial markets operate. So I very much concur with what Alexander have mentioned. And probably the highlight is that for most of the investors, as well as the investment professionals, it became clear that we are now entering a new normal of structural breaks. So we were speaking before about fate tales, about high probability of extreme events, but really extreme events that, at least to a certain extent, were predictable or capable of being somehow quantified through a modeling paradigm. What happened is that we've entered a mode of structural breaks. And through that, there are several important implications, which obviously have different caveats depending on the investor type. But probably to start very high level, we understand now that we need to start incorporating far more exogenous factors when we consider risk management. And by exogenous factors, I mean factors such as social climate, political risk, climate as a whole, and so forth. So what that means is that the risk management profile and risk management modeling becomes much more difficult, because we need to start thinking not in terms of correlations, but in terms of causality. And that is far more difficult to model in a structured, quantifiable way. So from that perspective, we do need to reconsider our modeling approaches. We did observe very severe structural breaks in the correlation structure, not just between the different sectors in the equity space, but markets and risk drivers, there was very significant break in the correlation structure across the board. And this is simply because it's not sufficient anymore to think in terms of correlation. Diversification means very little nowadays. So we need to be rebuilding our paradigm. And probably one of the biggest topics for us to reconsider now is in terms of long-term investors, how to really build economic scenario generation engines properly, having in mind this new environment. So this is a big topic. The typical macroeconomic relationships definitely don't hold anymore. They were not holding prior to COVID, now even further. So that's one big topic. Another big topic is on the stress testing side, how to design realistic set of stress tests, but not only that, stress tests need to become actionable. They need to be equipped with a measure of plausibility for those stress tests, and they need to be understood from the standpoint of having an execution plan. Stress tests could be diverse in nature and can even contradict to each other. So what is more important is to be able to, first of all, assess the plausibility, but also to have an action plan. Why? Because during crisis, what is most valuable is time. Suddenly, during crisis, the market clock starts to run much, much faster than our physical time. And in an hour, much more could happen compared to normal business conditions. For that reason, you need to be equipped with a set of scenarios on how to execute on related to your investment strategy, action items to be taken, and so forth, instead of thinking through this when the events are already in motion. So stress testing is the second topic that we are discussing with our clients, equipped, however, with these plausibility measures and making them actionable. Another very important component, and it does relate to assets under management and how they flow through different investment vehicles. We do see a lot of interest, and this is definitely confirmed by the trends in the market in general, in alternative investments and private equity investment as a whole. A risk profile of private equity investment is very different compared to public markets. So yet another topic that is rather important for our clients and the clients of our clients. So I will pause here, so that not to be very long, but there are definitely a lot of other considerations that we can speak about related to how what are the probably most efficient investment vehicles, how the risk profile changes and so forth, but let's see how the conversation goes, and yeah, I will find the proper way to make additional comments.
Oh, thank you, Borjana. It will be very interesting to know what happened in the kitchen of the asset managers. I think that most of our attendees today and our viewers, they all want to know what happened with, for example, with the mutual funds, with the ETFs and the other structured products that the asset managers are introducing to their clients. Did we see a shift between the different mutual funds types that the investors want to have? For example, somebody who invests primarily in bond funds has desire to invest in equity funds due to the positive results in the previous 2 months, for example.
Hi, Krasmira. Let me maybe start. So I think this really has been a year of two halves again, shall I say. And with a big sell-off in March, obviously, and continued also volatility in April, we've seen a lot of investors needing to de-risk their portfolios, especially institutional investors. that needed to lay off some risk, especially in the equity space, but also some of the credit investors that have done that. But we have very much seen them coming back pretty much starting after summer, if I like. So there was I'd say that in general, if you look at the industry, there was outflows, not only at us, but in the industry. There have been outflows in March and April, which were very pronounced. And then May was also weak, and then it kind of flattened out. And then it really, on a net basis, spiked up. And they've come back to risk assets in general, I'd say, equities, credit, including investment grade and high yield. We've also seen, for our side, we've seen a big move into also private assets, which have been more important, and alternatives in general, because they kind of dampen the volatility a little bit. If I may make a comment on active versus passive. So I think usually when you have tactical moves in markets, people tend to go with beta-driven products as well to play them tactically. Okay, so but if you ask me on a mid to long-term basis for the next 5 to 10 years, say, I believe the beta rally is over, and that kind of, for me, makes general investing of, putting all my money in a passive S&P 500 ETF and just lean back and wait for the nice returns to roll in. Those days are over, because, as I said, volatility will go up, and there will be much more also within the index. There will be a lot of opportunities and separation between winners and losers. We've already seen this now in the sell-off, but this will even be more pronounced going forward. So to me, I think the time of active managers, after quite a challenging 10 years for active managers, it was difficult with all that money flowing around to outperform indices, which have no cost. As an active manager, I think the active management piece has now really come. And that is for more traditional markets, and even more so, for emerging markets, to just name one, maybe China A shares, for instance. Yeah.
Okay, and Peter, do people seek professional advices more than the previous year, for example?
Yeah, I need to say that we have a different experience country by country in our group. And surprisingly, for example, our experience in Czech Republic, it's very different compared to the past, because Czech investors are usually very, very conservative, very, very cautious. We have one of the largest assets in money market instruments, etc., etc. And right now, the people react and follow the professional advisories and have been very active during the March and April and May, and investing, were buying equity products. For me, it was really surprising because as I said, local investors are usually very, very conservative, but they are, let's say, experienced. They have seen a couple of crises already in the past. If it was European or Euro crisis 2013-14, then financial crisis 2008 and 9, dot-com crisis 2001-2. So now that they have been the first one who in fact looked through the valley and invested into the equity markets, which it's a specific. Of course, at the beginning, many of the transactions were done through the passive funds, which it's understandable, because for the quick reaction to the market, it's to buy the passive fund the easiest way, and then they were starting to look for the let's say different strategies. I agree with Alexander in this view regarding passive active management, because we have had a very, very stable period of 10 or 11 years of growth where everything was growing, frankly. Now we are in the different situation, and from our perspective, the stock picking, so deep analysis and differentiation between the different companies, it's one of the important things. We should also keep in mind that probably after this COVID crisis, we will see a significant change in the economy approach. Unfortunately, I think that some of the sectors will never recover to pre-COVID crisis. For example, airlines or tourism and things like that. I think to recover back to pre-crisis levels is impossible, or it will take decades. On the other hand, we have segments which are growing fastly. On the other hand, we have the other segments which will be suffering. People right now are accommodating with buying everything through internet. So we are now buying everything through internet. So why I should go to the stores anymore? So I think the shopping centers, the stone stores, etc., could be in the problems. It will just speed up, the current crisis will just speed up the trends we have seen already in the past, because the shopping malls, etc., for example, in the United States, they were suffering already in the last 5-10 years. Right now, it's even faster. So I guess it will be very interesting and very important to be active on the market. And third thing in this passive active stuff is look at the indices or largest holdings, for example, of S&P index 20, 30 years ago. And if you are buying equity market for your pension or etc., those are usually very long-term investments. And look at that. If you look at the top 10 holdings in 2000 or 1990, out of these 10 companies, 6 already doesn't exist, and another 2 you never heard the name. So the situation is changing dramatically. Right now, these 5 companies, which have been a marginal 15 years ago, are now counting for 25% of the index. Okay, Microsoft already exists 15 years ago. Apple as well, but was struggling like hell before the iPhone. And then you have the Facebook, Amazon, and Google, which were not existing, in fact. So the time is changing very rapidly, and the active management will be much more in focus, I guess.
I agree fully with you, and I would like to ask Borjana to share with us if more of the biggest part of the institutional investors, what is the best hedging strategy they had this year, and what they plan to use next year, for example.
Yeah, so before we go to the hedging strategy, I would probably want to speak a little bit about the core first. And when we speak about active versus passive, we definitely see stratification towards the investment vehicles and how alpha and beta is being structured. So within the institutional owners space with much longer horizons, we definitely see that the core is being implemented typically through passive approaches, through ETFs and others. And we then see a rising component of smart beta, i.e. trying to replicate certain elements of alpha through cheaper vehicles. And we see that smart beta in the equity side has become already mainstream, but we do see a rise in the fixed income smart beta over the last year. And definitely a lot of focus on everything that has particular strong ESG tilt. So ESG is another whole theme on its own that is becoming in an implicit way, I think, but even further important based on the COVID situation. So we can speak about this as a standalone topic because it does deserve a lot of attention. And then on the top of that, tactical overlays in order to kind of capture the short-term alpha, we see really the pure active component and the pure active investments. And it can go across the board, and certainly it's this balance between the core that fulfills the long-term strategic objectives versus the short-term approaches to capitalize, to capture alpha as well as to hedge risk. With regards to the risk management, so on the alpha side, first of all, what we see is definitely interest in strategies that go deeper in understanding alternative data sets. Within FactSet, we have the open FactSet platform, which contains alternative data sets that are FactSet owned, but also provided by third-party providers. And this is one of the fastest growing areas for our business. So in order to extract alpha, you need access to newer unexplored data sets and be able to actually analyze them and extract signals very efficiently. So this is definitely one trend in the pure active space that we see, and we expect a lot of growth. With regards to the risk mitigation strategies, again, that's a huge topic, but definitely a lot of interest is being put into derivatives management. So Peter mentioned volatility, and Alexander as well will be increasing. That is exactly the case. I shouldn't say several, but we did observe certain mismanagement on the derivative sides because of the low volatility periods in the previous years. So we now see putting back attention into having very strong risk monitoring and risk threshold controls on the derivative side. Certainly, with regards to general hedging overlays, we do observe alternatives that is less liquid securities, private equity including, as being used as hedge instruments, a very novel trend. I don't know whether this will become like something very real, but there is an attempt to do tokenization in the private equity space, as now basically lower AUM, lower investments are not plausible for this market segment efficiently. So those are probably a few of the interesting aspects that I could mention.
May I add one thing? Because all of us, we touch the active passive. And I said that I see some time could be changed in favor of active, but this is valid for the equity markets. We see now different trends on the fixed income side, I think, and on the fixed income side, the era of passive investments, it's now coming on the place. It is more and more attractive. People are looking more and more for passive investments within the fixed income range. I think it's partially driven because of these buyback programs of the central banks. Once you know that central banks are buying everything what's on the market on the credit side, you don't need to differentiate so much between the different issuers. So people are much more okay with fixed income ETFs. So could be different trend, equities and fixed income side.
Peter, can I just add something to that? Because I partially agree with you, but only partially. So one thing, I want to make one thing clear, okay? I mean, we are an active manager. We don't have any passive investments or, smart beta. Not sure something like that exists, but, let's say, okay, we don't have it. If beta can be smart, but...
we do.
I'm not saying passive investments is bad. It's not. It has a very valid place in people's portfolios, okay? So if you wanted to execute short-term views, you want to get quick access, especially if you shift big amounts of monies, it makes perfect sense. Also, in markets that are usually and generally hard to beat, for an active manager, it makes perfect sense. There's certain parts of the market, and even in the equity space, that are not replicable. Okay, so I was based in Hong Kong for 6 years, so I'm very much skewed towards Asian equity markets. I'm telling you, you put money in Asian equity markets passively, all you get out is all the crap that you don't want. So for markets like Asia and a lot of emerging markets, you need active managers like us. Okay, for more developed markets, we can discuss. Now, let's come to fixed income, because that's a very interesting one. ETFs in the fixed income space have kind of ballooned, and the offerings, I mean, it's not so much in assets yet, but the offerings from passive investors have really, increased. I'd say this, on the, when we talk about government bonds, especially in G7, on this G7 side, very juice is left, if any. And managers like us might obviously have certain costs that are attached with it. It can make sense. If we talk about credit, and the more you leave investment grade, the more you go into high yields, and the more you want it to be active, it's almost impossible to have a sustainable kind of positive return or positive outcome from passive investing. So I'd say true, there are more, it's reformed, and the ways that passive investors or manufacturers can now also make use of fixed income markets lends itself for it, but I'm not saying it should be something that people should consider.
Thank you, Alex. And in the light of your comment, I would like to ask all of you, what do you think about the liquidity of the fixed income next year? What will happen due to the fact that now we have so big issues now on the market? Almost every country has increased its debt, and now we will see bigger movements on the market, on the primary market, but not so bigger on the secondary market. So what would happen with the liquidity of the fixed income next year?
I'm not a fixed income guy, I'm equity guy. But what I see on the fixed income market, for example, in our country, but also in other countries in the region, there is one thing I would like to address. And it's, from my perspective, the liquidity surprisingly declining because of regulation. In the past, there were a lot of new regulations coming to the financial banking sector, which was closing down their banking books or limiting their banking books, etc. So banks become less active on the fixed income market. And right now we have, of course, a significant inflow coming from the governments and also corporates, because they are joining this party for free, means very low interest rates. They are joining this as well, and we have the market flooded by the bonds. On the same time, we have the central banks on the one side, which are buying, as I said, almost everything, and we have also still a lot of money inflowing into the fixed income market from the pension funds and the others. So it's a bit tricky on one hand. On the other hand, it's different than it was in the past.
Yes, of course.
Yeah, to maybe just also address, I agree fully with Petr. I don't think we will have a liquidity problem, especially not when you think of the big developed market government bond markets. Clearly, if you go more into emerging market government bonds, that's a different issue, and they you should treat them more like a credit investment, if you like, because the default rate is obviously elevated, and you need to price the bond and your risk accordingly. So that's different, but I don't think, with all the support from central banks around the world, you will, and also the need from an investor point of view to invest into those things, I don't think we have an issue. And if you look at some of the issues that come out in the market where you think, 5 years ago, nobody would have even looked at a bond like that that's priced in that way. They are 10, 15, 20-fold, oversubscribed. And so it's not a problem to put, if you are a debitor, to put that into the market and to have it absorbed by the market. So I'm not seeing a liquidity problem here at this point.
Okay, and now I would like to discuss with you the market trends for the next year, what will happen, and in the light of the economy, and the different recovery stages that we will observe, and the levels of debt that they will have. So if you want, we could discuss what will happen after this celebrating market time now. We see what do you expect about the first quarter, maybe the first quarter of 2021 will be less developed due to the fact that we have lockdown measures, and in the winter there will be some restrictions remaining. But maybe after that, in the summer, we will see some recovery, and it will be very important what would happen then. And the portfolio managers need to have their strategies now, what they would like to invest in, and what they would like to do with the money of their clients.
Yeah, so maybe allow me to start and lead on that. So if I look at 2021, our growth forecast, many managers probably, is quite positive. We just upgraded our global GDP growth forecast from 5% to 5.2. So that kind of shows you the notion. We are very positive that there will be a rebound. And that is obviously fostered by, I think, two things. One is the clarity on COVID-19 and the potential outlook for a vaccine. Whenever that comes, and however many people will be vaccinated by, let's say, half 2021 needs to be seen. But at least capital markets have clarity on that some sort of a solution will be found, and we kind of go back to normal. So markets kind of look to that and traded on it. That's one. And the second is the massive support from central banks that is there, and that's always good for markets, which is also supported by fiscal stimulation programs, in the big G7 countries. So all in all, we are very positive on risk assets. Will we say that it's a straight line and everything will be going up in 2021 and you can close your eyes and go to sleep? No, we don't. I think you need to be careful. You need to, within the asset classes, be very, nimble, and also allow yourself to be maybe more tactical than what you've used to be. So there's no set and forget type of strategy. But overall, if we look at probably end of the year 2021, it will have been quite a good year for risk assets. And then I include equities, but also corporate bonds into that.
Mm-hmm. And thank you. And in the white, this question, I would like to ask you, what do you think, for example, Borjana, about the fact that we have seen that some of the financial institutions, for example, in Europe, for them, some of the regulations were postponed. Some of the stress tests also were postponed, and for the 2021, and they didn't perform their analysis now this year, and they have some stimulus. is this fruitful for them? Will it help for the investors not to stays their assets right now, or it's not a good idea for them, for the businesses?
Yes, interesting question indeed. First of all, just to second Alexander, although we do that for our internal purposes, just to have kind of high-level view on the markets. When we run our internal model, it's a slight extension of the very well-known Fed fund model based on the EPS and risk premium, and based on fact-set estimates. We have a very deep database of estimates that we offer to client base. We also see, although it's a model, so it's not a prediction, it's output of a particular model, we see actually very positive signs for the next year. Just as a comparison, in May for the US equity markets, we were seeing, based on that model, 5 of the sectors with a L-shaped recovery, 2 with U, and 4 with V. And now the picture is very, very different, as we only have 1 sector that is still in L recovery mode, and 2 within U type of recovery mode. So much more positive picture. It's a different question whether it will be sustainable, because it is yet to be seen whether the fiscal and monetary measures will be sufficient to really have longer term impacts. And there is definitely very strong bifurcation between the performance of the different sectors. So it remains to be seen how stable that would be, including our projections with regards to the future development of COVID, and to be honest, the behavioral aspects of our society as well that could change even if the COVID pandemic is kind of managed through and overcome. It doesn't mean that the behavior aspects of the society would not actually prefer to stay into this new mode, or closer to the new mode in some respects. So that's on the kind of investment profile for the next year. With regards to stress testing, I'm a risk person. I think that it is extremely important to be aware of what could happen. That doesn't mean to live by fears. That doesn't mean that you need to base your daily life and daily investment decision making based on the stress test, just an opposite. But you need to be aware, and you need to be prepared, and you need to know how to act. And this is exactly what we are trying to help our clients to do, to be aware of the risks and to have an action plan should such happen to realize. So I think that's extremely important, not to overlook risk, even when you see an upside potential to the market. With regards to the regulations, actually we do see increasing regulations in many respects. Europe and Asia are now incorporating much more advanced requirements for liquidity stress testing, which I think will be very positive, will have a very strong impact on understanding the risks and providing transparency into the profile of those investments. So I see actually regulators taking further care with regards to having the necessary transparency and proper management on the risk side.
Thank you. And as a conclusion, due to the fact that we have less than 10 minutes left, I suggest that every one of you could share some tip for our viewers. But I must say our disclaimer. This is not a professional advice, so your opinion is not a recommendation for the market. But if you want to share something with our public and for what exactly what they should watch out and in the next year in 2021 for their money, for their investments, and what should they do? Peter.
Okay, I was not asked for the outlook, but just for recommendation. Okay, now I'm a little bit cautious from the outlook. I need to touch it because I think we should differentiate between the economy. For sure, we will see the recovery. Frankly, it cannot be much worse than it was this year, because what we have seen on the economy side this year was enormous. On the other hand, we have quite large difference between equity markets and economy. That's enormous. That's a historical one. So due to this, I'm a little bit cautious. I'm understanding the power of the flows. I'm understanding the power of the monetary and fiscal stimulus. On the other hand, I'm value guy. You know, I'm looking for investments which make sense from value perspective. For me, it's a little bit difficult to buy something where I pay 180 times earnings, if there are any earnings. But I believe that for the next year, still the flow will cover this risk. On the other hand, we can see a significant shift from the stock performance. We analyze the performance of the value and the growth names in last 30 years, and we have seen a decade of growth names performing significantly in the 90s till dot-com crisis. Then and it reached the first highs. Then we have seen significant underperformance of growth names compared to the value. Value was outperforming in the decade between 2000 and 2009, this bottom of the financial crisis. And since that, we have another decade of the super growth of growth names versus the value. From my point of view, we are now entering a little bit different phase. We are now entering the phase of value performance, and I think that once the central bank will normalize their attitude, means ending of quantitative easing, rising interest rates or normalizing interest rates. I'm not expecting interest rates at 5%, but normalizing interest rates. Okay, maybe someone will say that normally it's a zero, but it's a different approach. But normalizing interest rates, surprisingly, we can see a very tough times for the equity markets. And I believe that in these times, the value names could outperform. So I will focus on value names. Right now, it's a little bit different what's value right now and what was the value 10 years ago. But the value, I think it's a strategy which now could be in focus. It's a much cheaper, makes sense from the long-term perspective, and it's less sensitive to interest rates.
Thank you.
Yeah, let me start by just addressing a few things from Petra. Sorry, but I agree with you to start with. Okay, I just would say that our old concepts of growth versus value, you also need to question yourself, and they're not really valid anymore. So whilst I believe the blind growth names with exaggerated multiples, that's probably very expensive, and some of them is not probably warranted. Yeah. So, but you want to look for companies that can grow their earnings and that can grow in an environment that's very disruptive, right? And in an environment that's very disruptive, you will always have growth names doing quite well and coming up from nowhere. You mentioned, the composition of the S&P 500 20-25 years ago versus today. You will see this, even amplified in the next 10 years. I assume, with so many industries and sectors being disrupted. So I say you want to have growth in your portfolio, but only what I would call quality growth or growth at a reasonable price, okay? And not outright beta growth type names. When you talk about value, I think the value investing style, to me, in the old-fashioned way, kind of buy cheap and sell expensive stuff. It's over, because what is cheap and what is expensive from an old value manager style, I think it's very difficult to answer. What I would say though is the quality element is going to be very important. Okay, so if you look at valuations, you want to look for quality. Okay, that being said, I'm not repeating we're positive on growth assets for 2021. We are. Let me try to extend the horizon a little bit to, let's say, a 5 to 10 year horizon, and name you two structural themes that I think are three that are going to be very important. One, watch out for China. China equities is obviously huge there's a huge tectonic shift and the competition between the US and China. China will continue to do well, and you need and want to look for China onshore names in the China A-share universe. Okay, so not Chinese stocks listed in the US or in Hong Kong or in Taiwan. You want to look for stuff that's listed in Shenzhen and Shanghai, and you need to have an active manager in order to go with that. But this is a big trend that we will be seeing. Second is sustainability and ESG, because I'd say 90-95% of our RFPs coming through will always have a question as to what our ESG integration model is. Okay, and I mean, I'm happy to say that we've said by 2021, 100% of Schroders AUM, should be ESG integrated, and I'm happy to report that we're almost there. 97% of all our AUM across the globe, which is around 550 billion, today incorporates ESG analysis in their investment processes, and around about 20% is dedicated just to sustainability. That's one. And the third and last one is we see quite a big trend going from public to private markets. Okay, so you've mentioned private equity and private debt, and if you look at how many companies have actually been delisted over the last 20-25 years, and companies that are private companies today and have launched and have absolutely zero ambition to get listed for different reasons, I think there's a different trend here. So if you're not thinking about private assets at the moment in your asset allocation, some might not be able to do that from a regulatory point of view, but if you're not thinking about it, you should. And that's all I wanted to say.
Thank you, Alex. And Borjana, maybe final 2 or 3 words.
Yes,
time.
Absolutely. So that I don't repeat the rest of the participants, I will probably take a slightly longer term perspective, which, however, to a certain extent sits on what Alexander mentioned with regards to the private equity component. What I'm interested in, and I can say that from both personal as well as investment perspective, is really to watch out after innovation. So digitalization, everything that contributes to digitalization, including human experience platforms, digital reality, digital twins even. Also, everything that relates to the new era of healthcare, Internet of Body, personalized and predictive medicine. Then when we speak about digitalization plus health, we definitely need to take care about advancements in the cybersecurity and personal data protections. So those 3 are really innovation areas that I think will see a lot of growth in slightly longer horizon than just 1 or 2 years, but critically important from a long-term investment perspective. And finally, technologies that are democratizing the technology itself. So technology will be becoming further and further important component of all the businesses, and everything that makes its use more efficient and cheaper, i.e. democratizing the technology, will have a significant potential for growth.
Thank you, Borjana. Thank you, Alexander, and thank you, Peter. It was a great discussion, and I hope our audience think as well as me. And as a conclusion, I would like to wish all our investors that with so many great opportunities out there, it is an exciting time to invest your money and to continue your path to financial independence. So be healthy, and we will expect you next time. And please proceed with the next panel. Goodbye.
Thank you. Have a nice day.
Goodbye.
Bye.